Good evening, folks. Hope everyone is doing well this evening. Just taking this opportunity, be a brief video, I promise you. Most of my videos are upwards of 20 minutes, walking, enjoying the views and stuff, and I tend to run over uh, 15, 20 minutes easily. So, anyway, so this is just a quick update for those of you who have not kept up with the news as of late. Regarding the U.S. escalation, and what investors need to know. Everything that's going on around the world is we live in a very connected world. Every geopolitical conflict, arises, instability, instability. Sorry, but yeah, and the markets react to it. Obviously that's anything that deals with energy, petroleum, natural gas, etc., etc. It just tends to affect us all. When we go to the pump to fill up our gas tanks, in our cars, and gas prices tend to go up when these sort of things happen. And so, again, this is a macro event, which affect us all. Like I said, when the U.S. and Iran, escalate tensions, markets, immediately price in three things, and this is just the basic stuff. Oil, if we follow oil, then bond yields and volatility, it's just a byproduct of all these things, going out of place or, just happening around the world, right? So if you're an investor, this will, definitely affect you, whether you hold equities, real estate, bonds, or crypto, exotic investments, right? So today I wanna just real quick break down, you know, from a purely financial lens. We're gonna briefly touch on some of these things. I know I've spoken before about some of the consequences of going to war, some of the byproducts that we experience as regular citizens, right? So, as to, how markets react to geopolitical risks, why oil matters most, what this means for inflation and rates, ultimately, if you're in the market to purchase a home, it's going to cost you a little bit more. Right now the 30-year-old, I mean 30-year-old, wow, what's going on this evening? The 30-year, conventional loans, they're hovering around 5.9, close to 6%. It depends on, your credit and, how the markets are doing and what the banking institution itself is offering out there. But credit plays a big role, obviously. Which sectors win and which ones lose, we're going to be touching on this briefly, but so let's get into it. And oil is the key variable here. Oil. That's the reason. I mean, I don't want to pinpoint anything saying that's the reason why prices go up or go down, or why one country decides to go to war against another, right? And we're not gonna get into the politics of this, but basically, oil is one of the key variables, right? When conflict involves Iran, market focus on one thing only. I mean, and that's energy supply risks, right? We here in America, at least, want to have stability. We would like to have predictability on gas prices. We go to the pump and we like to see, gas prices to be steady, jumping up and down like crazy, right? Everybody likes stability, and so does the markets, right? They thrive on this thing, and it's very volatile thing. So energy supply risk, a significant portion of global oil flows through as you guys know, the Strait of Hormuz, and this has been kind of like flashpoint, not just during this period when we had this war, but even before then, it was a flashpoint. The Iranians were stopping, oil tankers, whatever, and just sort of like that's like their negotiating card, right? This is like their ace, hidden ace, where they say, if you do this, we're gonna pull this one out, and you don't want none of that. And the U.S. kind of learned, real fast that that was strategic choke point, and they need to get rid of their flotilla, their fleet over there of small boats, fishing boats. I don't even know. But anyway, so they can transit through the man. I was gonna say the Suez Canal, the Straits of Hormuz, right? So anyway, even the threat of disruption, like it creates, a risk premium in oil prices, right? In crude. And here's the chain reaction, higher oil, like higher oil prices, higher transportation costs, to transport oil costs a lot more, higher input cost. I mean, there's higher consumer prices, there's higher inflation expectations. That's one thing, one certainty you can expect, higher inflation prices, or expectations rather, higher bond yields. So everything is interconnected. We live in an economic world where everything is supply and demand, and if the supply chain is disrupted along the way, the beginning, in the middle, or at the end, things escalate, out of control. Sometimes energy is a multiplier. If crude spikes, and stays elevated, inflation expectations rise. It just, you know, what happens? If inflation expectations rise, then what happens? Rate cut expectations shift, and that changes everything. We pay a lot of money, especially when we look at to like the holidays, and you have a business, you have materials that are required to run your business. Everything becomes more and more expensive. I mean, it's just the fact of life, right? Now, the bond market tells, it's an indicator, tells the truth, right? Equities react emotionally, the bond markets react rationally. So in the short term, investors often buy treasuries during geopolitical tensions. This is no news. This is no secret, right? It happens all the time. That can push yields lower initially, but but if oil stays elevated, then the yields climb. It's something to keep your eye on and to watch very closely, because that's an indicator right there. The 10-year Treasury yield, inflation break-evens, Fed rate cut probabilities, all these factors, everything comes into play, and it's something to, again, watch very closely as this thing develops, this conflict evolves, prolongates, or escalates into something more serious, major. That's something to definitely keep your eye on. Again, if yields rise, equity valuations compress. Growth stocks feel it first. That's just the truth. It's a fact of this whole equation. Growth stocks feel it first, real estate feels it next, and this is where mortgage rates come into play. So there's a sector rotation. There's winners and losers, as we all know. This is something to keep a close eye on. Some of these things are important to understand. So markets just don't fail, right? They rotate. It's a rotation, a cyclical rotation. There's more volatility. Just like stocks, a lot of people think about right now. A lot of institutional investors are buying tons and tons of, like, at these kind of rates, stocks, equities, whatever, and a lot of individuals, like investors like ourselves, right? I'm not an institutional investor. I'm not selling, right? But there's a bunch of people that they're very emotional and they sell when they hear the news. They sell, and guess what? The institutional investors are like, "Oh, this is the time to buy, to start stocking up," right? And so historically, during oil, driven tensions, the the outperformers, the guys that make the most money, okay, um, they're in a selected number of sectors, right? We can talk about energy sectors, we can talk about defense, utilities, commodities, so all of these, they're always have their eyes open, ready to jump on the bandwagon and snatch as many shares they were able to buy, or whatever the case may be. But this is the prime. This is the opportune time for you guys to look into, maybe dollar cost averaging right now. Like I have mentioned before, be smart. Again, this is not financial advice. I'm not your financial advisor. I know jack about anything. I don't know what's going on in the market. I do my own research. I invest on my own, findings and stuff, and I'll be happy to share with you guys some of the stocks that I have purchased over the years that have made me decent amounts of money. Some of my investment vehicles. Again, this is my experience, what I have done, and if you choose to follow my trajectory, you're more than welcome to do so. However, I'm not telling you what to do. I cannot tell you what to do. I'm not a financial advisor. I don't pretend to be a financial advisor. So do your own diligence. Sorry. This thing fell off. I'm sorry about that. And so I'm able to put this back in here because this is very challenging. Hopefully I won't mess up this video anymore. What I've already done here. Alright guys, and this is out of sync for some reason. Okay, it is gonna run it, but anyway guys, so we'll just do one more adjustment. It looks like we may be in business now once again. Whew, that was a close one. Anyway guys, if you see me out of focus, my apologies. Hopefully that took care of that. So anyway, we briefly touched on the outperformers, right? And then we have the underperformers. So airlines, transportation, consumer discretionary, small caps. So like the airline industry, right? They depend on fuel. They use fuel. That's their blood, that makes these airline companies stay afloat. If gas prices are really high, real expensive, it is rough for them. It'll like take away from their profits. But the trickle down economics of this is that us as consumers, we're gonna get stuck with the bill, right? We're gonna end up paying more for those airplane tickets. If you want to purchase something inside the plane, it may cost you some more money. You go to the airport, you want to buy a bottle of water, it's gonna cost you like $5-10. I mean, it sounds crazy, but I've seen prices like that in some airports here in the U.S. and around the world. So again, it's just creating this imbalance. Someone has to pay for this. This is the bottom line. Someone has to pay for this. Going to war is not like the government's paying for this. Or tax paying money pays for all this. That's the reality. I mean, pay taxes, goes into the infrastructure, social services, blah blah blah. The whole story. So this is not random. It's margin sensitivity. Higher energy costs compress margins in transportation heavy sectors, right? Like I said. Meanwhile, energy producers benefit from pricing power. So meaning, it behooves them to. I mean, I don't say that they're financing the war, right? They're not like dishing out, as far as I know, anyway. But it's just a byproduct of what's going on. So there's Fed policy implications along with this. Here's where it gets complicated, right? if inflation was cooling and markets expected rate cuts, then sustained oil pressure, I mean, pressure, what am I saying? Sustained oil prices disrupts the narrative, The Fed's dilemma, I mean, this is nothing new, right? This is no secret, right? They, I mean, if they cut too soon, inflation, what happens with inflation? Reaccelerates, right? It goes sky high. It goes high. So if they wait too long now to cut interest rates, growth slows further. I mean, this is um, this is what's been going on with the Fed. They're trying to cut interest rates. The government wants them to cut interest rates, but then the printing machines are printing more and more money. I mean, this is we have to strike the balance. Somehow, hopefully, we'll see a drop in interest rates because a lot of Americans are sitting on the fence, just waiting for interest rate to drop somewhat to be able to purchase a home. I mean, this is making it difficult for a lot of Americans to purchase their first home. And anyway, I think I'm kind of deviating a little bit, but like going back to the oil, oil shocks are, issues are stagflationary by nature. Slower growth, higher prices, markets will, reprice quickly if crude remains elevated, and it has to reprice. You have to reprice everything, you know, um, and a lot of capital flows. We know that capital flows into safe havens, right? Like during risk events, for the most part, capital rotates into, we talked about this before, but into U.S. Treasuries, the U.S. dollar, like especially overseas, like countries want to really don't want to hold any more treasuries. The U.S. Treasuries, they're moving into gold. Buying gold. Like a lot of places, like in China, they're buying tons, and all European countries still doing the same thing. I think the U.S. is doing the same thing. Brazil, um, and other Latin American countries are doing that. You hear about El Salvador, well, they're with the crypto, right? The government over there is implementing a lot of changes to their economic policies, right? Like I said, that shift de-risking, I guess, from U.S. Treasuries to gold, right? It's a hedge against inflation, against a bunch of other things. So emerging markets, tend to see, outflows. Crypto becomes interesting again. So people are looking for safe havens, right? Places where they can keep their cash. It could be gold, it could be crypto, Bitcoin, in a safe place. In a crypto wallet, right? So when crypto, I don't know if I told you this story, but I purchased like 5 Bitcoins, back in the day. They were like about $3,000, and then the fun part, I kept it for a while. I didn't know nothing about crypto, and I kind of heard Bitcoin, and I think let me see, I heard a story about them buying 2 pizzas or something like that for tens of thousands or thousands of Bitcoins. I said, man, look, it was like zero, now $3,000. I was like, man. So I pulled, out of my savings, whatever, 15 G's, and I say, you know what, I'm gonna hold on to this. I started to get bored, and it was going down, and I just like, man, I don't know about this thing, man. This is so it went up to, check this out, went to $700, in profits. I was like, oh my god, $700. All right. So I told some of my buddies, hey man, guess what? I just sold my Bitcoin, man. I got $700 in profit, man. I thought I was a genius. I was like, man, this is so great, And looking back, I said, what an idiot, One Bitcoin went to like 120 some $1,000 at the highest. So that just goes to show you, right? I mean, well, anyway, I think jump into something else. But what I'm saying is that, um, we know that crypto becomes interesting again, right? When a lot of other assets are really not looking that good, and there's a lot of instability. If you like keep crypto, Bitcoin or gold, I mean, it can trade as a risk asset, falling, um, how can I put it? From a risk asset, I guess, to falling with equities, or a hedge, again, a hedge narrative, with rising with uncertainty. So a lot of things, happen in the markets. It triggers this uh, sensation, this feeling of like I better put my money where it feels safe, whether it's gold, you know, uh, precious metals. I mean, I don't know. Precious metals are going up and down too. I don't know really too much about it, but I know that a lot of folks, some of my friends, do heavily investing in precious metals, and I think even copper nowadays is like it's becoming like this necessary piece of your investment. Like copper is going up in price too. So there's a lot of demand in copper, gold. A lot of the things that we built, in semiconductors, it requires gold. Other, I forgot the name of this thing, metals, fancy, no fancy metals, um, precious, semi-precious. Man, it escaped my mind. But anyway, precious metals are important. Gold, right? Um, and conservatively, if you want to think about treasury bills, park your money there. You won't be getting much out of it, to be honest. Crypto is a very interesting, a portion of the financial markets nowadays, and a lot of people do, jump into crypto, and others just because it's important to diversify your portfolio. Uh, so so um so that's it, folks. I think that's what I have for tonight. I mean, the experience you may see in the days to come, and right now as it is, temporary oil spikes, uh, and volatility will fade, if we kind of have a plan in place. I'm not saying that we don't have a plan where people can see, they say, okay, 1 week this thing's gonna be over. I mean, there's another scenario with, this is a contained conflict, right? The first one that I gave you. The second one will be more like a prolonged, tension. Like the war just continues, and there's no talks, there's nothing happening, and then we can, expect oil to to remain elevated, right, in prices, and the rate cuts get delayed. There'll be like no plans, or really just push it to the next whatever, and it just gets delayed. That's another scenario, the prolonged tensions. And I think the other thing would be a major escalation. There will be a supply disruption if the countries around the Gulf get entangled big time, and there'll be supply disruption and broad equity repricing. Right, everything's gonna end up getting more expensive. Just unpredictability, of the markets. It could trigger that, and unless energy supply is materially disrupted, this is a risk. Premium event, not necessarily a structural economic shock, but it's something that will ultimately affect all of us, here in the States and all over the world. If we get the cough, they'll get the pneumonia, right? I mean, that's just true, So let's, days to come, and, weeks to come, so stay focused on, oil prices, bond yields, inflation expectations, see what the analysts are saying, and Fed communications, if there'll be any rate cuts, or see what happens. And if oil stabilizes, markets will stabilize as well. If oil escalates, rate expectations shift, and that impacts everything from mortgage rates to equity valuations. So stay disciplined, stay diversified, most importantly. Avoid emotional positioning. Don't buy and sell a lot of emotions. If you found this breakdown helpful, um, do me a huge favor. You can subscribe for more macro focused finance analysis. So, and let me know if you have any questions. Please feel free to type it in there in the comments. I'll be reading the comments. So anyway, do you think this remains contained or does energy risk escalate? What do you think? So thanks for watching, and I'll see you in the next update. God bless.